Good morning and welcome. As Andrew was mentioning, my name is Lisa Ortner-Ghouze. I am the Global Head of Marketing for Financial Markets at Standard Chartered, and I will be moderating your opening panel of today. Before we begin, one very quick housekeeping rule. Since this session is only 30 minutes long, we will not be taking audience questions, but I would encourage you to find my speakers here on stage throughout the day and ask them any burning questions you might have. So without further ado, let's get straight into it. These are very interesting and challenging times. Central banks around the world have been struggling to keep inflation under control. We've seen a rise in interest rates, which has led many dozen countries, at least, to seek IMF assistance. The war is raging in Ukraine. We are, have been challenged with higher energy prices, ongoing disruption of global supply chains. All of this has had a direct impact on the shipping industry and posed a probably larger question around ESG overall. So how much are really global growth prospects impacted by all of this? And will we see the demand for shipping to continue to be as strong as we see today? Well, to answer these questions and more, joining me this morning on stage are James Marshall, CEO and founder of Berge, Abhishek Pandey, Global Head of Shipping Finance at Standard Chartered, and last but not least, Robertsen, Global Head of Research and Chief Strategist, also at Standard Chartered. Welcome, gentlemen. Thanks for joining us this morning. I'd like to start with you, Eric. And I know you're going to IMF in a few weeks. You speak to clients all the time. You speak to the press a lot about what is going on in global markets. And I know that there is one question you get asked an awful lot, and I'm going to ask you this very question this morning. Are we witnessing the end of globalization?
Well, look, I guess to start, the short answer is no. But what I would say by way of context is that since the US-China trade wars under the Trump administration, then commencing with the COVID crisis, and now with the Russia invasion of Ukraine and the longstanding military conflict, there are serious questions about whether the nature of globalization has changed. And to that question, I would say absolutely. Globalization as an economic theme, as a financial market theme, is not going to change. The shipping of goods, the shipment of capital globally is not changing. What will change is the cost of globalization. And this is not just an inflation story, right? This is not just about supply chains being impaired, challenged, or even broken down. There's another more significant factor, which is, as Lisa mentioned, as Andrew mentioned, uncertainty in the world has increased. Economic uncertainty, geopolitical, etc. We all know the risks have increased. And for anybody participating in business, markets, whatever, the cost of insurance is going. And so when the cost of insurance goes up, our frictional cost of everything that we do goes up. In financial market terms, we say hedging costs have increased. But there's a lot of ways to describe that. Now, in a normal world, pre-COVID, inflation was low, return expectations for asset prices and businesses were lower. And so if there was a small cost of hedging, you didn't care. You continued to go about your business. The cost of financing was low and the return opportunities were good. But what's happening today is the cost of financing has gone up and the cost of hedging has gone up. And so I would argue that for people thinking about new businesses and the shipping associated with that, there will be renewed scrutiny of how good the business or market opportunities are. So no, globalization is not over, but it's going to be a lot more expensive.
Thank you very much. Interesting perspective. I mentioned in my opening that there has been a big question mark around ESG overall, and we've got James here on the panel. And as I understand it, you're one of the industry leaders on decarbonization. I've done my homework, and I've read that you already have cut emissions by around 45% compared to 2008 levels. So what makes Berge Bulk so focused and successful in its quest towards net zero?
Well, thank you for that. Look, I think it's a very much been part of the business since we started back in 2008. So it's been central to what we do. Um, I think one of the worries, as you said, with you know, deglobalization is that we may see a cutback, over the last couple of years in terms of what's happening with sustainability. I think during COVID, we saw the world kind of shut down, and yet the amount of carbon reduced was just about 2.5 gigatons of carbon was reduced out of our daily output. So even though the world shut down, we still didn't reduce very much carbon, really. I think we need to reduce something like 60 gigatons per annum as we go forward by 2050 if we're going to keep the world at 1.5 degrees. So we're not there. And I think we need to be very aggressive at that. So at Berge Bulk, I've been trying to do that since we started in 2008. And I kind of talk about a four-pronged strategy of attack. And I don't use the sort of war metaphor lightly, but I do think we have a war on climate change, and we're trying to make that a central part of our business. So in terms of our four strategies, the first strategy, which you mentioned, was really to make our fleet much more efficient. And we did that by building bigger, better ships, but also modifying and improving the existing fleet. And that resulted in us seeing the savings. If we'd kept the same fleet as 2008, today it's 45% more efficient. And that also comes to an interesting point because our IMO goal is to improve the efficiency of the fleet by 2030 by 40%, and that's really too slow. So I kind of want the goals to be more aggressive, and we've tried to set that out. The second part of our strategy is to really do the same again, but using new technology, and that's where a lot of investment is coming in. So that's again improving the existing fleet. We've got better technology which has developed over the last 15 years. So, for example, we've just put a shaft generator onto one of our ships, which creates electricity off the shaft, and then put that into putting bubbles underneath, so aero bubbles, which lowers the friction of the ship and will make it go faster and reduce fuel. So there's a lot we can do today in terms of improving our footprint, and that's very kind of central to what we're doing today and what we can impact. The third part is new fuels, and I'm sure we'll hear a lot about that over the course of the next 2 days. But that's things like carbon-free fuel, so probably as a long-term solution. But there is also talk about nuclear even, and then biomethanol as a sort of interim fuel. And then another area of that is carbon capture. And I think that's an area that we need to invest more in. We've got to get this 60 gigatons of carbon out of the atmosphere. So I think one of the key things is to try and capture that carbon. That may be onshore, or that leads on to my fourth strategy, the fourth pillar, as it were, which is around carbon capture, not on the marine environment, but elsewhere. And I think we're all beholden to try and do that as quickly as we can. So that may be physical, direct air carbon capture, or even using nature-based solutions as a method. And that's led us to try and or our target is to be carbon neutral, carbon zero by 2025. And we'll have to do that using offsets as the final part of that.
And would you say, James, that the private sector as a whole is doing enough?
Well, I think the short answer is no, for the reasons I just said. I think if we take what the private sector and even the government sector and the public sector has said, those targets to be effectively carbon neutral by 2050 will result in a temperature which is higher than 1.5. So it's the maths doesn't work. So I think we need to be much more aggressive on it. I'd like to see banks be even more aggressive on it. I know you have good targets, but we as I see it, if we wait until 2050 to see a reduction in carbon and then offset the final volume in 2050, it's too late. So let's start offsetting that volume, capturing the carbon today, and obviously reduce down to zero our emissions by 2050 if we can, or where we can. But we need to start that process, faster and quicker. So that's, what we're trying to do at Berge at the moment.
Thank you so much. That's a good segue to bring you, Abhishek, in on the conversation. Banks were mentioned. You, not to age you on stage, but you have been in the banking financing sector for quite a while. So you've seen different players come and go. You've lived through the global financial crisis. You've seen many banks shut their ship financing operations in Asia. And I'm just wondering, has this at all changed the type of financing and refinancing conversations you are having today with clients or not?
I think to answer that question, probably we'll have to see where shipping was when the global financial crisis actually occurred. I would say shipping came into the global financial crisis in its 20th something cycle of the industry, and which was propelled by the Chinese economic boom. What happened during the crisis is classically what happens any on the top of the cycle. The mistakes were made in financing. There was a lot of leverage, very cheap in structures like KG, KS, with little to no equity coming in. And when the demand slumped, so did the freight rates, the asset prices, leaving all the capital providers absolutely exposed. So much so exposed that a lot of them actually shut down their shipping businesses, and majority of them also retreated back to their domestic markets. Now, this is exactly what is today. We are sitting on the top of a shipping cycle, probably propelled through the pandemic, the war, an industry nuanced way, I would say, a bit of a benign incoming supply of ships. But if the reconfiguration of the globalization has to happen, and the second theme which James talked about, ESG, has to happen, I would say shipping could come out of it in a very different light out of this crisis. Why? Predominantly, I feel there are two changes that are happening in the industry, which has never happened in many, many decades before. Banking, insurance, and shipping have been one of the most orthodox industries in the world, which have seen very little to very slow innovations. But that's changing. There is a very strong structural change in the industry, which James just talked about. Is basically you're coming out from a top of the cycle, your balance sheets are super strong, you've got cash, you've got financing available as well, but guess what? You don't know what technology to order and what fuel to back. So basically that's creating synthetically a slowdown of the supply, which is good for shipping. Shipping is not that complicated, except that demand has to be always talked with supply. That's one cause. The second cause, I think, is basically there is an absolute paradigm shift, which again James referred to earlier, right, with respect to the, I would say, quote unquote, war on climate and the action on climate management that is required. I just saw my old friend Rasmus walking into the room, and I think he'll talk more about the industries which are peripheral to shipping. But it's important to understand for the ship owners today that it's not localized to shipping, the change. It is happening to all the peripheral and associated industries around shipping, which shipping is derived from. So you're not alone. And I guess that is what will push shipping into a position where there will be, if the discussions happen properly between the capital providers and the owners, and if they happen towards more about the right assets, the right pricing, which is risk adjusted, repeat again, risk. Owners don't like to hear that word when they talk to bankers, so I would repeat it. And I guess, the right pool of liquidity providers who will come with this capitals. Are these the banking capital finance only? I'm sitting here, but there are asset managers, there are pension funds, there are insurance companies, there are alternative investment funds, there are public-private partnerships, there are governments. I am glad that MPA is standing behind this. So I guess there is a huge amount of involvement from all sorts of liquidity providers which needs to be leveraged to make it happen. And if these are the kind of discussions are happening not only with the ship owners today, but with fellow capital providers as well, I would say. And if that happens, and if we are successful, I think shipping can come out very differently in a recalibrated way of a newer fleet, which is more resilient future-wise. So I think the capital providers have got an extremely important role to play in this market.
Thank you very much. I don't think we can talk about shipping with also making reference to China and what is going on in China. So, James, What do you see? What do volumes imported into China look like at the moment?
Yeah, look, I think obviously China is going through a tough time with COVID lockdowns at the moment, and we have a macro backdrop which is difficult. But actually, from our perspective, we see volumes are reasonably resilient. Um, Shipping and certainly in the larger sectors that I'm involved in dry bulk has started okay the year, and then kind of dipped quite substantially over the summer. Disappointing. And I think that was largely, though, more to do with an unwinding of congestion within shipping. So post-COVID, for the rest of the world, uh, restrictions were removed, and a lot of ships were released back onto the market. So that led to a sort of disappointing Q3. But in terms of China, actually, we've seen, as I said, volumes has been okay. We're seeing some signs of improvement now. We saw a really quite big kind of issuance of local government bonds throughout China through the first half of the year, and I think even still going on, and even maybe have tapped into some of next year's quota and issued now. Now, there's normally a kind of 6-month lag on infrastructure. The impact that we see from the issuance of those bonds towards the steel industry. So when I look at the steel complex, actually this week, we saw a 2% increase from last week in terms of daily output, but more importantly, since July, we've seen a 14% increase in steel output on a daily basis, and if we compare that with last year, actually it's 8% up on what they were producing at this time last year. So we're sort of seeing some increase in steel, and actually steel prices have been reasonable, slightly increasing over the last month. Slight drawdown on steel stocks as well. So I think we're seeing some of those sort of infrastructure spend coming through and helping demand. I think we still have a major problem in China with housing, but China is a country where we're actually seeing a decrease in interest rates as opposed to the rest of the world. So I think in its own area, we'll still see reasonable volumes going into China over the in the future as well as now.
Thank you. You stole my thunder a little bit, because that was the next question I wanted to pose to you, Eric, but never mind. In fact, it struck me as very interesting that we see interest rates rising all around the world, yet China is a bit of an outlier because it has not only kept them flat but actually reduced them just recently. So can we expect, Eric, a turnaround in Asia's largest economy this year? What do you think?
This year is probably premature. I would describe China's outlook as extremely cautious at the moment, and that's probably being polite, and I won't repeat all of the issues that we know exist. China will recover. Let's be very clear. They will recover, but the recovery will come later and will be a little bit more protracted than we're used to. I mean, over the last 20 years, we've seen that every time China has any kind of an economic retrenchment, they throw the kitchen sink at the problem. But they're not going to do that this time. They're not able to. But I think the previous comments were extremely important for this audience, because for all of China's economic problems, which we know are related to the consumer, to the labor market, to the real estate market, all of that actually is a very positive message for the shipping industry. And I say that because if you've spent any time in China over the last 10 years, you will have been told that their economy is changing. It's becoming more consumer-driven, more services-driven. The old export model is being de-emphasized. Well, guess what? They're changing back again. And they're going to go back to pulling the levers that have always worked for them, which is more infrastructure spending, more fiscal stimulus, more of a focus on old-fashioned infrastructure development. And that will mean more trade, more shipping. And so our view is that China's recovery will be slow, but you're going to see a lot of the evidence of activity that we saw 5, 10, and 15 years ago. So again, for this audience, I think there's actually a bit of a silver lining in that cloud.
Thank you. I think we're coming towards the end of our session. So I would like to wrap it up because the theme of the conference today is New Shipping Horizons. So I would like to ask my fellow panelists one last question, and that is in 3 simple words. What will these new horizons look like? James, why don't you go first?
In 3 words, I have to say net zero future.
Wonderful. Abhishek?
I would say risk, discipline, resilience.
Thank you. Eric, you get the last word?
I'll do it in 2. Tectonic shifts.
Thank you all very much. Thank you for our audience for joining us today. Thanks to our fabulous speakers for sharing their wonderful insights. James Marshall, CEO and founder of Berge, Abhishek Pandey, Global Head of Shipping Finance at Standard Chartered, and Eric Robertsen, Global Head of Research and Chief Strategist. Thank you all very much, and goodbye.
Thank you.